Who pays capital gains tax on a trust? When it comes to trusts, a common question arises: who is responsible for paying capital gains tax? The answer can vary based on the type of trust and how it handles income and gains. Let's break it down in simple terms. First, we have grantor trusts. In these trusts, the person who created the trust, known as the grantor, is responsible for reporting the trust's income, deductions, and credits on their personal income tax return. This means that any capital gains realized by the trust are taxed directly to the grantor. This typically applies to revocable trusts and certain special needs trusts where the grantor retains control over the assets. The grantor pays capital gains tax at their individual tax rates. Next, we have irrevocable trusts. These trusts are separate legal entities with their own taxpayer identification numbers. When an irrevocable trust sells an asset and realizes a capital gain, if that gain is not distributed to the beneficiaries, the trust itself pays the capital gains tax. Trust tax rates can be quite compressed, meaning they can reach the highest tax bracket at relatively low income levels. This can lead to significant capital gains taxes for the trust. Now, let's talk about how capital gains are taxed based on distributions. Whether capital gains are taxed to the trust or to the beneficiaries depends on the terms of the trust document and the applicable state law. If capital gains are distributed to beneficiaries, those beneficiaries report the gains on their personal tax returns and pay the capital gains tax. However, if the gains remains in the trust pays the tax. Some trusts have specific provisions that dictate how capital gains are treated in distributions, so trustees must follow consistent practices to allocate gains properly. Another important aspect is the step-up in basis for inherited trust assets. When beneficiaries inherit assets from a trust, those assets may receive a step-up in basis to their fair market value at the time of the grantor's death. This can reduce or eliminate capital gains tax if sold soon after inheritance. However, assets in irrevocable trusts funded during the grantor's lifetime may not always get this step-up, meaning capital gains tax could apply when beneficiaries sell those assets later. From the perspective of estate planning, understanding who pays capital gains tax on a trust is essential. Proper trust funding, the choice between revocable and irrevocable trusts, and clear provisions about income and capital gains distributions can influence tax liabilities for everyone involved. Consulting with an attorney can help minimize capital gains taxes and protect assets for heirs.